Hi, this is Professor Cataldo, and I'm going to walk you through a nice simple example from a textbook that I use in advanced accounting of a nice example of the translation method of accounting. That's a US GAAP method. It's one of two US GAAP methods, just like different methods of inventory valuation, LIFO, FIFO, weighted average specific identification, or different methods of depreciation, straight line, double declining balance, modified accelerated cost recovery system, sum of the years digits. Except this is usually taught at the advanced accounting level. We're dealing with international transactions, firms that have operations in other countries with different currencies. And so this is a nice example of the translation method of accounting. And here's the fact pattern. And it looks like on January, Padre Corporation, that's a US based company, formed a new subsidiary in Honduras, Succursal Inc., with an initial investment of 150,000 Honduras lempiras. And they want you to assume that these are events that occurred on precise dates. They purchased inventory evenly throughout 2000 X7. Ending inventory was purchased on November 30 X7. They use straight line depreciation on fixed assets. They declare and pay dividends on November 30 X7, and they purchase fixed assets on April 1 X7. And they want you to prepare a schedule to translate the financials from a foreign currency to US dollars. Now here's the starting point. What you want to notice is that all the debits are on the top and all the credits are on the bottom in the worksheet. You also want to notice that we have exchange rates, spot rates for particular event dates, January 2nd, April 1st, November 30th, December 31st, and we have an average during the period. Now, in broad and general terms, you're going to use the average during the period for the income statement measures. That's a broad general statement. Okay? The income statement shows results of operations over a period of time, so you would use the average. The balance sheet shows measures at a point in time, so you're more likely to use the exchange rate at that particular point in time. So we're going back to the basics. Income statement, period of time. Balance sheet, point in time. Keep that in mind as I go on to the next slide. Look at the balance sheet measures. The cash, the account receivable, the inventory, the note receivable, the property, plant, and equipment, all balance sheet items down below. Accumulated depreciation, it's a contra asset, but it's a balance sheet item. Accounts payable, bonds payable, mortgage payable. In all of those cases, for those balance sheet items, I use the December 31 X7 exchange rate. Okay, balance sheet, point in time. Balance sheet, point in time. I'm translating at a point in time. Now look at some items out of the income statement. I'm going to start at the top. Cost of goods sold, depreciation expense, other expenses, and at the bottom, sales. Period of time, so we use the average over the period. Income statement shows results of operations over a period of time. So those are the basics. That pretty much solves almost everything. Let's take a quick look at the dividends. That's a little different. That is the exchange rate on the dividend date. And look down below, common stock. That is the exchange rate when they purchase the firm by issuing common stock. So, balance sheet, point in time, income statement, period of time. What are some of the exceptions? Well, the exceptions in this case are in the owner's equity section, aren't they? They are the common stock, which is an owner's equity item, and they are the dividends, which is a contra equity account, also presumed to be in the owner's equity section. dividends, after all, are closed out to retained earnings, and you would prepare a statement of retained earnings for the period. So think in those terms: balance sheet, point in time; income statement, period of time; uh, and then precise event dates in the case of dividends and common stock, both owner's equity items, common stock in the balance sheet, dividends, contra equity in the statement of retained earnings, but it flows into the balance sheet. One more thing to pay attention to: when you do these translations, you're going to start out with debits equaling credits in the foreign currency, the Honduras lempiras. But as a result of these translations, since you're using different translation measures for each item, each debit and each credit, your debits are not going to equal your credits, and you're going to have to plug the difference. And in this case, the difference is 382. It's highlighted in yellow, and it's accumulated other comprehensive income, OCI, other comprehensive income. Hope this makes sense and helps you out a little bit. There's the journal entry: debit other comprehensive income and credit the investment in Secursal. Thank you.